Today's lesson, I'm here to simplify options for you. So let's talk about 4 misconceptions. Number 1, options are extremely risky. Number 2, options are only for the most sophisticated of traders. Number 3, options you need much money to trade. Number 4, options are extremely hard to understand. All of these are misconceptions and simply not true. If you stick with me through this video, I'm going to give you my options example that I entered into this morning that I think will return anywhere from 100 to 300% by the time the expiration date rolls around, which will be in September. I'm going to explain expiration date and all these other terms for you. Stick with me. So first, let's keep it simple. If you buy a call option, you want the underlying derivative to go up, to go higher, to go as high as possible. If you buy a put option, you're hoping your underlying derivative of your stock goes down, and it goes down as much as possible. So let's talk about terms so that you understand exactly what you're doing. The most important term is premium. Premium's what you're paying for each option contract. Then you have your strike price. Your strike price, I like to choose in or at the money. What does that mean? Well, the strike price gives you the opportunity or the right to either buy 100 shares if you have a call option or sell 100 shares at that strike price if you have a put option. So real quick, I'll just give you a simple example. Say you have a strike price of $25 and your stock goes to $30. You have the option to buy 100 shares per one option contract at $25. So of course you would do so because you could buy it at $25 and sell it at $30 the same day, thus making a profit. If you have a put contract and your contract allows you to sell the stock at $25 and your stock goes down to $20, that's great for you. That means you're making money. You have the option to sell 100 shares at $25 and the stock is currently $5 lower. Let's talk about expiration date because this is very important. The closer the expiration date is to the current date, the more risky your options are. So I mentioned before that options really aren't a risky investment. Why? I use options to lever my positions, meaning I choose an option date that's a few months out. So for my example, we're gonna go and we're gonna use a September option. So we're May 6th, we're using a September option, so that gives us 4 months for our stock or our underlying derivative to either move up or down. In the case of the example I'm gonna give, I have calls, September calls, and I'm bullish. But before we get into all that, when you speak about options, you always hear about the Greeks. Delta, gamma, theta, vega. What do all those mean? And people say, if you understand the Greeks, you'll be a great, profitable options trader. That's not true. I know a lot of people that understand the Greeks to a T, and yet they just can't trade options. They say if you understand the Greeks, they're here to help you pick the perfect strike, pick the perfect expiration date, and again, make money. So what's most important when choosing an option? Most important is that you are correct about the direction of the stock. If you're bullish on the stock, then you want it to go higher. And if you're correct about that, your options will make money. Now, if you think the stock is going down and you're buy puts and you're correct, the stock goes down, it doesn't really matter what strike or expiration. As long as you're correct about the direction of the stock, you're going to make money. But most important, and what I teach to my platform members, is planning ahead. So when we enter into a call option and we think the stock is going up, we don't just jump right in. We don't pay the ask. What we do is we set a bid that is lower than the current price of the option. For example, let's say your option is $2.40 or $240 per contract. I would tell my platform members to put in a bid at $2 or $200 per contract. That way, if the stock goes down, it clicks over the price that we need to hit and our order gets executed. So rather than paying $2.40 per contract, we pay $2 per contract. When the contract price goes back up, rather than being break even at $2.40, we're now up 20%. This is very important. Entry point is most important. Not chasing is most important. Planning ahead. The same is true when you sell your option. and I'll quickly explain so I don't have to cover it later. When you're selling an option, you're anticipating a spike in the price. With the spike in the price, your options price will go up. So if you plan ahead, you can put in a limit order to sell your options contract as soon as it gets triggered. So I don't care whether you want to make 20%, 50%, 100%, everybody's different. But the only way to secure max profit is to plan ahead. So you take that $2 option that I talked about, and if I want to make 50%, as soon as I buy that option for $2, I will go into my system and I will put a sell order and I will ask $3 per contract. Meaning I'm going to make 50%. Whether it gets triggered that day, that week, or the following week, I really don't care. It's indifferent to me. I'm just looking for the percentage gain. I'm looking to make 50%. So everybody's different, whether it's 20, 50, or 100%, but you must plan ahead. So I spoke a little about the Greeks. I'm going to cover that one more time. With the Greeks, delta, gamma, vega, theta. Which do I use? I only use delta. And why? Because delta is most important in determining the price of your option. If you have a delta of, let's say, 0.50, and every option has a delta, so don't be like, oh, I'm not sure if mine has a delta. It's there. It's in the top right corner. So you take your delta of 0.5 and you take your price movement in the stock. So if it moves 2 points to the positive side, you take 2 points times 0.50 and you get $1. So your options price will go up by $1. The same is true to the negative side. If your stock price goes down by $4, for example, and you multiply it times the delta of 0.5, you get $2. So your option price will go down by $2. It's just math. It's just using the delta and multiplying it by whatever price movement you're guessing. Always make a prediction. When you're entering into an option, you always have your entry point, your exit point, and your strategy, which is in between, of why your entry point is going to get to your exit point, and you're going to make 20, 50, 100%. So hopefully you're with me so far. Most important of everything is your stock's direction. Your stock must go up if you're bullish on the stock and you're buying calls. Your stock must go down if you're bearish and buying puts. So people will talk about the Greeks being most important. Not true. You must be correct about the stock. So finally, let's get to the options example that I've been speaking about. The options example that I believe will return you and myself anywhere from 100 to 400%. And I don't think it's a complex option. I don't think it's a risky play, and I will quickly explain why. The option, first of all, let's timestamp this right now. It is May 13th. It is pre-market, and I'm going to explain that in a little later. But my stock is Delta Airlines, symbol DAL. My strike price is $42, which means I have the option to purchase stock at $42. I'm assuming Delta will go up by then. I'm hoping it's between $50 and $65, which will put me in the money. Okay, so Delta Airlines, strike price $42, expiration September 17th, 2021. Yes, I bought out a few months. That makes this option play safer. I don't have to get the stock to move up right away, tomorrow, next week. I've got a number of months before it comes due. Excellent. So what happens right now? The stock or the option price pre-market is $5.30. Well, I don't want to pay $530 a contract. I don't want you to pay $530 a contract. So what do? How do we apply the lessons that you've learned in this video? Excellent question. We take Delta Airlines stock, which is at $44. I make an assumption that it's going to go down $1 today to $43, and that's where I'll purchase my option. So my option price is currently $530. I look at the delta of the delta option, which is 0.60. So I take 0.60 and I say the stock is going down by $1, so my option price should go down by 60 cents. Did you get that? I take the stock price that I assume is going down by $1 because I want to secure the best entry on the biggest dip, and then I multiply it by the delta of the option, which is 0.60. So my option price is going to go down 60 cents, so we're at $5.35 pre-market for my contract. I'm not paying $535, I'm not paying $530, I'm not paying $500. I'm putting in my order at $475 per one contract. Again, $475 per one contract. The date is May 13th. I have till September 18th, 2021. Now, what do I expect to happen? Since my option allows me to execute at $42 and I'm basically paying just under $5. So my strike price is $42. I paid $4.75, so my break-even price is $46.75 for Delta stock by September 17th. So that's $46.75. Let's add $5 to that. Let's make it $51.75. That happens, we make 100% positive returns. $51.75. Well, that's nothing. Delta's at $42. I mean, your strike's at $42. The stock's at $43. $52 doesn't seem that great. Okay, well, let's say it goes up to $56. Now we're at 200% return. Okay, and so on and so forth. If it goes to $61, now we're sitting at 300%. Should it go to $66, we're sitting at 400%. Now you might say 400% return, that's crazy. This option's so far out, it seems so logical. Yes, I have simplified it for you on this video. If you like what you've seen in this video, please subscribe to my channel. Everything we do is organic and it's based on you followers and your likes and you're watching my videos. So if you're learning something, please share it with a friend. Follow my channel. I would love to see you and get alerted. Push the notifications. As soon as I drop a new video, you'll be first to be notified. Also, every day I do a live stream at 4:30 p.m. where I talk about the market and exactly what we're seeing, and I share this with you free of charge. So please join me at 4:30 every day.